Welcome to the weekly update, where I'll go over the action in the market for the week of August 11th through the 15th, and we'll see how things look for the week of August 18th through the 22nd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, so we set an intraday all-time high with the Dow, but then it gave up a lot of those gains on Friday. We set an intraday high with the S&P, although we did set closing all-time highs earlier in the week. And we're still waiting to see, okay, we're halfway through August now. I've been watching this since halfway through July. Is there going to be some seasonal weakness? Are we eventually going to get to the point where the market at least starts to pull back? Doesn't look like it's really happening yet. We saw a little bit of a build up to that. We're seeing pockets of it in different places, and I'll go through that as we go through the video here. But we're not seeing it really based in price. And price is the ultimate indicator. No matter how many moving averages you use, oscillators, any kind of mathematical formula that you try to throw on a chart, it's price that ultimately is the most important thing. Okay, so let's go back through the week's session. For the week, we were up 0.94%. Still, it was up, but not as much of a gain as we saw last week. And we were still above average with volume. Now, most days, if you look at the daily chart, we're below average. But if you count it all up, it's still above the moving average on the weekly chart. But it has been dropping off, which is not a surprise for the summer months. We are still positive, and we've had 2 up weeks in a row now. We're also dealing with some pretty significant overhead resistance that I will pull out. And I've been trying to bring that up in pretty much every video I do. Because this can be a big deal. It can be a big deal if this resistance level is broken and we go higher and close higher on a weekly basis. This could also be about where we top out and start to come down. We don't know how it's going to play out yet. So we are still positive. Now, interest rates are going back up a little bit. We're still below the 4.5% level. We had some mixed signals this week. We had CPI come out, and that was seen as market friendly. We were going up. Everything seemed fine and dandy at the same time. Then we had PPI come out, and that was much stronger than expected. And that's thrown some water on the market right now. It's like, okay, inflation might first hit at the producer level. These are the people that make things. And then if it hits there, they're going to pass on the cost to the consumer, which is the consumer price index, or CPI. That's the thinking that's going on right now. You have Trump and Putin meeting right now. There's variables with that. Trade deals, tariffs. What are the impacts of the tariffs going to be? A lot of variables that the market is trying to digest as we come into this weaker seasonal time of the year, especially when we deal with a post-election year. We have yet to be positive going back to 1950 during a post-election year. Well, we could always break that trend, but we're only halfway through the month. So there's still the other half yet to go. All right, as far as our trend, we're still in a weakening trend. It's still positive. The green line's above the red line, but the ADX is now below 20 on the weekly chart. We're starting to see on the daily side, in the short term and intermediate term, a new trend developing that is positive. We crossed above the moving average on those charts. We're below the moving average and below 20 right now here on the weekly side. So even though they gave back a lot of their gains, small caps were up the most. Earlier in the week, inflation seemed under control. It came in as expected. The market's already figured out that, okay, we're already going to be at those levels. Let's go out and buy some small caps. And that helped it, and the mid caps as well. But then we saw some give back in Thursday and Friday session. So is that going to continue? Is this just a short-term blip before they get ready to go higher? Now, the Dow was up 1.7%, and a lot of that has to do with earnings reports being received positively. And if you hear a cat in the background, he says hello. The NASDAQ was up 0.8%, the S&P up 0.9%. All right, so here are some bullet points just to go through. Positive inflation data early in the week. Now it turned kind of negative in the week later. So CPI was good. PPI has folks a little bit confused. Earnings are still pretty solid. We're pretty much beyond the bulk of earnings being reported right now, and continued rotation into smaller cap and cyclical names. These cycle with the economy. The small caps did give some back, but they were doing pretty good earlier on. Is that going to continue? Because we've seen this before. The small caps and mid caps, they start to break to the upside. They have a good couple of days, and then they just start going down, 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 and giving back all the gains that they've had. Is that what's going to happen this time? The S&P, the NASDAQ, and NASDAQ 100 set multiple, not only intraday all-time highs, but closing highs as well, with a big S there. The Dow did set an all-time intraday high, but not a closing high. It was up on Friday, but it gave up a lot of those gains. CPI was largely in line with expectations. The market liked that, and there was confidence really growing of a 25 basis point cut at the September meeting. Now, there's even, after the CPI report came out, you started hearing, okay, how about a 50 basis point cut? And folks started to get kind of hot and bothered about that. And also, fueling a rotation towards sectors and stocks poised to benefit from friendlier interest rates, and that's small and mid caps. And the mega caps saw more muted gains. They're still holding up, but we're seeing a little bit of a shift, and especially on the daily side. And the PPI report tempered some of that enthusiasm from what on the back of the CPI report because it was much stronger than expected. And then you had some Fed speak this past week. It provided mixed signals, such as now, Scott Bessent is not a member of the Fed. He was floated around as possibly being the next chair of the Fed, but he doesn't seem to want to do that. And he was actually out advocating a 50 basis point cut. Now, he works with President Trump. President Trump wants interest rates down to 1%. Because of the previous administration doing their little trickery, they financed a lot of U.S. debt with short-term maturities. Those are going to come due this fall. And that's why President Trump wants interest rates lower, because us, American taxpayers, are going to have to pay for that. And he would like to be able to refinance this at lower rates. I mean, that makes sense. Even if you're not a businessman, that still makes sense. And then Chicago Fed President Austin Goolsbee, gotta love that name. He is a voter on the FOMC, cautioned against overreacting to a single month of data. Well, they do it all the time, but I guess it's not okay for us to do that. I try not to do that. We try to always take a bigger picture look at things, which is really hard to do when you have, in the short term, big things happening. And that's why in the videos that I show, I like to show longer term charts to say, okay, this is what's happening right now, but the bigger picture is still looking like this. Don't lose focus of what's going on, because people tend to think that the way things are right now is the way they're always going to be, and they make long-term decisions based on short-term actions in the market, and that can work against you probably more than it works for you. So he emphasized the need to discern with price increases are transitory. Back to that word again. And then St. Louis Fed President Musalem, who's also a voting member, and San Francisco Fed President Daly, who's a non-voting member, but was a voting member and is still pretty influential on the FOMC, noted that the PPI readings did not necessarily warrant a 50 basis point cut. The market was starting to talk about that and getting a little giddy over that. But then the PPI came out and was like, no. Now, if we start to see the data coming out between now and the September meeting, and it's showing inflation, even a 25 basis point cut might be in jeopardy. So he indicated a more measured approach would be considered at the September meeting. And then we did go up with interest rates. We're at 4.33% there. So overall, the week showcased the market balancing optimism around rate cuts with caution over inflationary pressures and sector rotation. We are seeing some moves also that are getting more defensive. Small and mid-cap stocks, strong earlier in the week, a little bit weaker as we finished out the week, along with home builders. Now that is showing some improvement there. Watch the intermarket analysis video for that. Healthcare, which is a defensive area that has just been getting hammered. And so you might have some folks coming in and starting to say, ah, these are pretty good prices. I think I'll buy here. Hopefully I'm buying at the low, but it's also a defensive sector. If we're getting ready to go down, healthcare will probably hold up better, if not even advance, if that is really what happens. So while mega caps lagged, emphasizing a broader risk-on environment. That was earlier in the week. We started to see some risk-off tendencies come as Thursday and Friday unfolded, that extended beyond the narrow mega cap leadership. That's what we had been seeing. It was the really big stocks that were driving the indexes. Earlier this week, we saw broad market moves, and it's like, okay, the market's really starting to look better. Then PPI came out, and that's caused some problems since then. So we're still watching this. As far as CPI, that's what this chart shows. We're still going down with the dark blue area here. Just to be aware, this is one of those long-term charts that I like to show. The way things are now is not necessarily the way they're always going to be. If you go back to the mid-70s or so, we had low inflation at that point, and then we really skyrocketed up after that. Hasn't really started to happen yet, but we just want to keep this in the back of our mind and keep our big picture focus in tune. All right, then we're at 4.33%, and we have been seeing good earnings. Companies lowball it, they come out, they beat expectations, and that really helps the market to go up. And most of the time, a lot of the time, it will help the individual stocks go up, but we're still above the 4.02% level. So earnings are still positive, but less positive than what they were, let's say, back in 2024, as far as projections. Okay, then this hasn't been updated. It won't be updated until we get the September employment report, nor will this chart be updated until then either. And yet again, for the second weekend in a row, I go to Isabel.net and try to look at their blog, and they don't update it when I'm recording this on, it's a Saturday my time, later in the day. It's early Saturday morning for most of the US right now, and maybe that person is taking weekends off. All right, so FactSet, now that we're beyond the bulk of earnings season, we only have one blog post right now. And I did actually point out this chart in one of the daily videos because it showed up at Isabel.net. 87% decline in companies that are citing recession on their earnings calls compared to the first quarter. So we're seeing a real drop off there. Companies aren't fixated on that. They're not talking about it as much. Here is the chart where it started off on Monday. We saw some selling going into the close. And then Tuesday, this is when CPI came out, and we gyrated up, gyrated down. But then after all that mess got done, we were able to go higher. This dashed line is the previous all-time high, and we were able to close at another new all-time high. Then we hit Wednesday. We set the high right after the open, spent the day coming down, but then we actually saw a little bit of strength going into the close. Not back to the previous high, but it was well off the lows of that session. And it's not on here, but there should be a dashed line here. That was a pivot point, a support level that held. Then we came into Thursday, lower open, and we went up. It was very choppy. Not a lot of conviction here. We closed just a little bit off the high. Then we actually came down in Friday session and then came all the way down to S1. But then again, whenever you see a support level these days, right now, these are the buy the dippers. They're like, okay, this S1 level, it's holding up. I'm going to buy. And they get their little profit, and then they get out, and then we ended up closing near the low in Friday session. So not a real positive day that way. So looking at the sectors for the week, and this is just the 5 trading days. It's not Friday to Friday. It's Monday through Friday. All of the different, did I say sectors? I meant indexes. They were all positive. But the NASDAQ 100 underperformed, as did the NASDAQ and the S&P. We saw small caps. Even though they gave up some of their gains, they still finished pretty solid. Mid caps were down just a little bit, and the Dow had a pretty good week. This goes back to the beginning of the year. Small caps, believe it or not, they're still negative on the year. All the other indexes are positive, led by the NASDAQ 100, the NASDAQ, and then the S&P. The sectors here, just showing it more in a spreadsheet form since we had an up week. See, healthcare, that's a defensive area. It was the strongest. It was up the most. If you look over here, and I'll show this on the next chart, look at their scooter score, though. We want it in the high 80s, low 90s. If something is really strong, it's at 7. Can't even get up to 8, at least yet. Now, communication, that's a growth area. That's looking better. Discretionary is doing a little bit better as well. And then you have materials, and the financial sector ended up being up, but it's still underperforming the S&P. And we're a little bit concerned about that. Is there a warning sign that we're getting from this? For most of 2024 and even into 2025, the financial sector was leading. Now it's starting to lag behind on a ratio basis. Do we need to be concerned about that? I'm not really seeing any news yet. I'm just seeing what's happening in the charts right now and wondering, okay, is this price leading something that will come out that will impact the overall financial sector? And then we had utilities were down, staples ended up being down. These are defensive areas, so they bounced back up, but they were still negative on the week. And tech ended up being virtually unchanged, but also slightly lower. Now, looking over here, the scooter score, tech, communication, those are the two growth areas. They're in the 80s. And then down here, we have materials, real estate, healthcare. Even though healthcare was solid this week, it still doesn't have a really strong score. And the same can be said about energy as well. Then, just for the week, here are the sectors. Staples were down, utilities were down, industrials were down. Where we see healthcare looking pretty solid right now but again, watch the intermarket analysis video and you'll see how the healthcare sector has really been underperforming the S&P. Communication, which is a growth area, ended up being up. Discretionary, that was up as well. All right, then year to date, we still have healthcare. Even though it had a good week, it's not having a good year, at least yet. And this brings out I want to buy at lower prices and sell at higher prices. This is also a defensive area that if the market does go down, those folks might be positioned in a little better situation. Then you have energy, which is negative, discretionary still negative, and we have communication and tech. Those are still positive, and those are the big growth areas year to date. So we saw some green, we saw some red. You see the tech areas. Apple was up. It didn't have the monster week that it had last week, but it was still up over 1%. Microsoft was down a little bit, 1/3%, where Nvidia was down over 1% on the week. When these stocks don't perform really well, the index, the S&P, the NASDAQ 100, they have more problems with actually going up. Now, I will say, look at the financials. These are the 5 trading days. This isn't just a daily market carpet that I show in the daily video. A lot of green here. Now, that's good. We want to see that. We want the financial sector to really hold up and actually start to go up. So this is encouraging from that aspect. And then discretionary, we had Amazon was up pretty strong. Tesla was virtually unchanged. Then we get into healthcare. Eli Lilly, they came out with their earnings, and that really bumped up the healthcare area. And you look at communication, Google, Meta, they were up, but not really, really solid. And we finally are seeing Netflix starting to go back up. Seemed like it was just setting new all-time after new all-time high. And then they started to drift down and drop below its 50-day moving average. And now it just can't seem to go up at all. So it's kind of encouraging to see that one go up as well. And then Walmart ended up being down with the staples as well. All right. So this is the relative rotation graph. We're trailing off a little bit here with XLK. That's tech. Now, this goes back over the last year, as I say every time when I show this, but it's still one of the stronger areas where we're seeing industrials pulling back. And then XLY, this is discretionary. Kind of real zigzagging here, but it's looking a little bit better. These are still some areas that are weak. Now, over the last year, XLV, that's healthcare. But it's starting to turn up, but it hasn't come out of this red area, at least yet. Here, showing it a little different way. Tech is still looking strong, where then we have industrials. That's more yellow. Still a lot of negative areas here, but some of those are showing some improvement, where we're holding up okay, real zigzag form here with discretionary. Then this is looking at the different indexes. We still have the NASDAQ 100 looking the strongest, and then the S&P 100. The S&P 500, it's been camped right around this level now for a very long time, where we're seeing utilities show some weakness. We're seeing the Dow Jones Composite, a little bit of weakness. The mid caps, they were looking good earlier on, but then we're seeing some strength in the small caps and a little bit over the last year in the transports. And then so we see the S&P 100, the NASDAQ 100. Those are the strongest areas. The S&P 500 is still strong from a trending perspective. It's just underperforming when we compare it to other indexes. Then the mid caps, composite, and utilities, they're more negative with improvement happening in the transports and small caps. All right, and then sentiment, we got the reading here from Investors Intelligence, not seeing an extreme reading. That's if we get above 3 or below 1. We're right about in the middle now at a little over 2. Then looking at the fear and greed index that I use most of the time, we closed at 64. We're up in the positive area now. And then to give you a little bit of context, now a week ago, this was starting to look a little, actually 2 weeks ago, was starting to look a little bit more negative. Now the context is that we're starting to go back up. So we're treating this as more positive now. Active asset managers, they have become extreme here. They did drop down in our latest reading, coming in at 85.56. This is that same chart, just I get it from a different source. And we're still below 20 and holding kind of steady here with the VIX, both with the line chart and the bar chart. But this is, and I'm showing the same chart in the daily videos. This is what concerns us. Historically, in August, September, and into October, sometimes even into November, this is when the VIX has a tendency to go up. And if this is going up, that means stocks are going down. We're not really seeing that yet, at least to this point. We're still looking positive here. When we compare cash to the tech sector, the black line is still going down. That means tech is outperforming cash. And still seeing with the RIDEX bear bull ratio, we're getting a very low reading. That means folks are still quite bullish on things. We did see a little bit of a drop down here with individual investors in their latest survey. They were kind of negative. They're a little bit more negative with this latest reading. And we're still below the moving average with the Ulcer Index. We're still not seeing any real problems here when we look at the spread between risky junk bonds and not risky bonds like government bonds. And this is that same reading, but inverted, where when this is going up, that means fear is going down. Still declining overall when we look at the VIX and the 3-month average of the VIX. That's positive. We're still declining with the very long-term equity put call ratio moving average. Then the economy kind of bumping up a little bit here, but not really seeing anything that's really trending. We're just kind of moving along sideways. The latest reading from the Chicago National Financial Conditions Index, we're still below the black line. That's good. And then the latest reading from the GDP Now estimate coming in at about 2.5% or so. And they've kind of held at that for the last few readings here, where the economists that you ask, they're about 1.75% to the upside and just a little bit negative here to the downside. And so this is positive in and of itself. We're looking at positive GDP for the second quarter and a projection for the third quarter to also be positive after we had the first quarter that showed negative GDP. We have to have 2 quarters in a row for part of the definition of a recession. Also, the Nowcast people from New York, they're still coming in over at a reading over 2 here with GDP. This won't be updated until the first part of September, nor will this chart, nor will this chart. I still include them because we kind of have to go with the latest readings that we had with these charts. This is the Inflation Nowcast. It updates every day. We're actually bumping up a little bit here, and that kind of shook the markets when the PPI report came out. And then there's a 92.1% chance that we're going to see a 25 basis point cut at the September 17th meeting. All right, but then we're getting a little bit more locked into that here, where we're seeing a drop off now in the folks that thought rates were going to be held at the same level of where they are now. And then going out into the next meeting after that, which will be October 29th, still leaning more towards being 50 basis points or 0.5% lower than where we're at right now. And seeing a little bit more conviction developing with that take on things. But this changes all the time. Still declining with the Fed balance sheet. I just like to look at this once a week. It's been telling us the same thing since June of 2022. That's when we topped out and the Fed started doing their quantitative tapering instead of quantitative easing. Still going up for the most part, though, with a year-over-year look at the Fed balance sheet. And dropping down a little bit here. Watching this, the overnight reverse repurchase agreements, is this feeding in a little bit to what we're seeing in the financial sector? But the financial sector had a pretty good week. So maybe this going down is actually seen as more positive. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, still looking at our longer term weekly chart of the advanced decline line. We're positive based on price and volume. Then we look at new highs, new lows, the weekly chart. We're going back up, but we haven't quite crossed the moving average with the 4-week, and we're starting to turn back up with the 10-week moving average chart. Declining here, but still above zero with the advanced decline ratio. And we're still below 20 with the ADX. That's the dark line here. That means we're not trending right now, and it's a weakening non-trend, meaning that it's at first it became a weakening trend. Now it's a non-trend. Hasn't switched over. It's trying to turn up a little bit here, but we're still well below the moving average. But we are positive because the green line is going up and the red line is going down. We're above zero and going up here with the Arun. That's positive. And still, we had this triggered right near the end of, was it May or June? Long time ago now. But as I stated a week ago, the further we get away from this signal, the less relevant it becomes. But this is actually a reversal that we have yet to really see anything happening. You can see the bars up here, higher highs, higher lows for the most part, still looking pretty healthy. So this is a daily chart, and we're still dealing with this pivot point here on the daily side, but we're still in an uptrend. You can see most of the days over the last week were below the moving average. Then we have a 50-week moving average. We're still above the red line. Price is above that. The red line's going up. That's positive. Then we use a moving average crossover here. The blue line's above the red line. That's positive, and price is above both. This is the chart that I'm honing in on right now. Now, this is at 46.48, which I rounded up from 40, or I'm sorry, 64.68. Yeah, only 2,000 points off there. But we have not cleared this R1 level yet. We went a little bit above it, but by the time we closed, we were a little bit down right here. This could be kind of a big deal. We've been going up really nicely. Are we going to hit this resistance point and something's going to happen? The market's going to turn more negative, and then we're going to come down from that until we can close above this on the weekly chart. And we might go above it Monday, Tuesday, Wednesday, and Thursday. But if then we tank next Friday and we come down below this resistance level again, we didn't break it, even though we went a little bit above it this week. We have not really closed above it yet. And then here is the long-term trend channel. We're dealing with the upper side of this trend channel here, which could be acting as overhead resistance. And I actually found a chart that follows the technical analysis rules. This tries to pair up with the chart that you just saw here. This and this are supposed to be identical, except they have some different lines in here where we're hitting the upper end of this trend line. So if you want a little bit more confirmation, I found this on X, and they're showing the same thing that I'm showing on the previous chart. Now, we look at our 3 smart money indicators. They're looking good. But here with the boom indicator, we're above the red line. That could be extreme. See, other times when we got to this point, sometimes that suggested exhaustion here. But we're above the red line and going up. This is positive. And we're going up with the chicken money flow here. That's looking good. The daily chart is negative. And we went, okay, I'm going to jump up to this one. We declined with the chicken oscillator on Friday, but we haven't fallen below the moving average on the daily side. We're still going up here on the weekly side. Now let me go back to this one. The vortex, positive, but the green line's coming down after being extreme. The red line's kind of bouncing down, and it's still extreme negative there. Okay, then we look at the McClellan oscillator. We're below zero, but we are going up. And it's negative when we're below zero. So we're declining here with the summation index based on price. We actually ticked up a little bit based on volume. And volume leading price could be more positive. And we did see an improvement. We're still positive on the daily side with the bullish percent index. And we're going back up here and also above 50 with the weekly chart of the bullish percent index. We're above zero and going up with the swollen trading oscillator based on price and volume. On the daily side, we've switched over to negative after Friday's downward move. And we're declining a little bit here with the PMO based on price and volume, but the PMO itself is still going up. And we're seeing some improvement with the PMOs in the S&P that are going up on the weekly side. We're seeing a bit of an improvement with the buy signals, and after dropping off, we're starting to go back up with the PMOs that are above zero. We are positive with the force index. And we did get for 2 days a percent B reading on the daily side, and we've worked that off since then, but we are above the midpoint here on the weekly chart, and that's looking positive. And so all of our momentum oscillators, you can see the slope oscillator, man, it's just going to the moon. So these are our two short-term ones, three intermediate-term ones, and two long-term ones. We're still negative, but trying to switch over positive on the daily side. And we're trying to switch over positive on the Copic curve chart as well, where we're flattening out here this way. And we're still getting a very high reading with the money flow. We're getting extreme here with the Stochk RSI. On the daily side, we're just a little bit above the midpoint. It's one of our short-term indicators that's not showing a lot of strength right now. But the Williams percent R is, both on the daily side and here on the weekly side. And we're above 50 and going up with the RSI. We're also still above 50 with the ultimate oscillator. We were up, but not as much as we were up in the previous week. So this came down a little bit, but it's still below the above the midpoint. And we're coming back up here with our rate of change going back 50 weeks. That's looking better. And now we're finally getting some confirmation. Only took a couple years, but we're positive on the daily special K chart, and we continue to be positive here on the weekly special K chart. And then I haven't adjusted these yet. I'll wait until we start to actually set a high and then come down a little bit, and I'll readjust these Fibonacci retracement levels. So looking at the trend on the weekly side, we're positive here with the Heikin-Ashi, positive with the Kagi chart, positive with the Renko chart, and still positive with the three-line break. And we're still looking good on the daily side as well. It's what we're seeing under the surface that is giving us a little bit of concern. But we want to see more than just 1 or 2 days of that. We want to see the trends actually develop. And not enough of an upward move to draw in any X's. We're still looking pretty solid here with the point and figure chart. Still working off of the last signal, which was a double top breakout, because we finally broke above these previous price levels. And that was generated back on June 2nd. And still above zero, but coming down a little bit is the ease of movement. We're still just dancing barely above zero on the daily side. Long-term momentum, still looking good. Coming up a little bit here with the intermediate term, and we're looking more positive with the short-term PMO. But remember, this is short-term weekly chart, so it's still longer term. I know it's a little misleading. And we're neutral still with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. Positive on all time frames in the short, intermediate, and long term with all the indexes. Bonds are negative in the short and long term, but looking okay in the intermediate term. Commodities are seeing a little bit of pullback in the short and intermediate term, and the dollar, which has been helping stocks go up, is still negative across all time frames. That's another thing to watch for. If the dollar really starts to go up, that could also put some pressure on stocks. So far, other than a couple of days here and there, it has not been happening. So here are the S&P indexes in the mid caps and small caps. So just coming off of a recent all-time high, still a ways to go with the mid caps and the small caps, and they're still underperforming. The Dow set an intraday all-time high, but not a closing high, still looking positive though. The NASDAQ recent all-time high and an uptrend. NASDAQ 100 all-time high, recent all-time high and in an uptrend. And here are the mid caps where we saw a crossover on the daily side. Now we're seeing a crossover here on the weekly side. And the small caps still having a ways to go. Now this is the S&P 600. The Russell 2000, that's another small cap index. And I don't have a chart of that here. And that one might be looking a little more positive. I just use the small caps as a reference point. I don't invest in them. Then the NYSE, not setting a new all-time high, but still in an uptrend. The Wilshire. This is a daily chart, just kind of chopping sideways after setting an all-time high this past week. All stocks, U.S. and international stocks, still looking pretty solid there. The FANG index, recent all-time high. That's the big stocks. ARK is still holding up well. It was up over 3% this week. And now this bank chart looks pretty good. We're above 50 with the RSI. We were up 1 1/3%. And the MACD is rolling over here, but it's still positive. And then seasonality, this is for August, where we're up 60% of the time, but the average return is a minus 0.3%. Then here is Dow theory, traditional Dow theory, just looking at the Dow near an all-time high, not being confirmed here by the transports. They are improving, but they're not close to their all-time high, where the utilities are just coming off of all-time highs. And a traditional Dow theorist would not include utilities in their analysis, where I do. And we're still in an uptrend here with the commodities, but they were only up about 0.5%. And oil, we're watching that mainly for geopolitical reasons. We've actually been dropping down. We're getting to the lower 60s now. And here's the weekly chart of the dollar, which you look at the daily chart, we're in a downtrend. Here on the weekly side, we're also in a downtrend. And that has been helping stocks. At some point, the dollar's going to go down enough and people are going to really start to get into that area and push it back up. And if that happens, like I said before, is that going to put some pressure on stocks? That's why we watch this. And gold just continues to chop along sideways. Silver looking a little more solid here, but it was down over 1% on the week. And then copper, it was up a little bit. It's still in an uptrend here. It's trying to bounce back up after it was flying around all over the place last week and the week before. And we're still looking good with the long-term chart of bonds, a weekly side here. Looking good with the monthly chart of the stock to bond ratio. And seeing how the interest rates were coming down and now they're starting to go back up a little bit here, and that could pressure stocks if that continues. And this is the weekly chart. And I'm keeping an eye on the Japanese one. That's the red line here, the land of the rising sun, because this is what caused a problem a year ago when everybody was freaking out and the VIX went to like 65 or something. And people that didn't even know how to spell VIX were suddenly posting about it on X and talking about it. And they were demanding a 1.5% rate cut now and another one at the next meeting. Well, that lasted about 3 days and the market got beyond that. But interest rates going up in Japan, if they continue to go up, could have a negative impact on the US because Japan owns an awful lot of US bonds. Then gold is still hanging on to most of its gains. And then we have stocks in second place, then commodities, then bonds based on price. Oil is still negative year to date, and the dollar, which has continued to just kind of go sideways in this negative pattern. Then the NASDAQ 100 to S&P ratio, it came down a little bit, but it's still positive overall. That's longer term positive. That's growth outperforming growth and value together. The S&P 100 doing pretty good when compared to the rest of the S&P 500. Growth to value came down a little bit, but still looking solid there. And we're still seeing where bonds are underperforming stocks. We're still seeing where the low volatility stocks are going down when compared to the S&P. So this isn't really turning defensive in the bigger picture. What we're seeing is more short term, and we could be seeing a shift. It might go away. We've seen that shift happen before, and it kind of turned into nothing. So that's what we're doing and evaluating things every day to see if that shift will continue. And gold to the dollar, and it's not that gold's going up, it's that the dollar's going down. That's what keeps this ratio up. Discretionary looking a little bit better here, up almost 3% when compared to staples on a ratio basis, and going down with the gold to S&P ratio because the S&P for the most part has been going up, gold's been going nowhere, and that's why this ratio goes down. And we're still seeing how energy is underperforming the tech sector. Small caps continue to underperform the tech sector as well, even though they bounced up a little bit. They were up over 3%. They got a long ways to go to get back above these moving averages at least, and then stay above the moving averages to turn positive, and it's a long way from happening according to this chart. Then some long-term trends, still looking okay here with the breadth rust, not really seeing much. I was pointing this out back in late June and into July that we saw a spike here with this WAG NYSE breadth thrust. That was not a signal. We were just getting a very high reading. And so far, we have yet to come back up to that high reading yet. That's a little bit of a longer term negative divergence. That's still there. Doesn't mean it's really much of anything. We just want to make a note of that. Still above the trend line with the S&P weekly chart going back to the 1987 crash. This is that same chart showing how we're well above the trend line. And we are improving still with the Zahorchak method. We were at a -10. We bounced up to a -6, but we haven't improved since then. And then the NASDAQ weekly chart, we're getting a little bit above the trend line now. And there was some concern that we might hit this and that might act as some overhead resistance. So far, it hasn't really been playing into that. And then the 50-period moving average of the new highs, new lows for the S&P starting to come down a little bit. We declined a little bit a week ago. This could be some weakness that's starting to come in, but overall, this is still positive since it's well above zero. Then we look at the NYSE new highs, new lows. This is a 50-period moving average here. It's actually declining a little bit as well. It's just getting really choppy right now. We still look at the NASDAQ, which is growth, NASDAQ 100 to Dow ratio, which is considered value. This ratio is still going up. The Qs to small caps, came down a little bit here, but well above the blue line. And we're actually dropping down a little bit here with the 3-month yield. Now, the reason why I look at this chart is this is back in 2007. Everything's just humming along. You got the stock market hitting all-time highs, and then everything fell apart after that. Okay, now we're just seeing a little bit of a move down here. So we'll keep watching this chart. I look at it every day. If this really starts to drop, this took us into the great financial crisis, and that was a very difficult time. And still going up with the cumulative new highs, new lows for the NASDAQ. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then seasonally, we're in the second half of August here. The arrow should be over here now. We're starting to move over to this side where we tend to perform a little bit better than the first half of August, and we're setting all-time highs in the first half. And then this also shows, this is kind of a composite together where we tend to top out in August and then start to go down. Hasn't happened yet. And this also shows during post-election years how August tends to be weak. And when we go from 1964, that's when the Beatles came to town, to 2024, we are only up 56% of the time with a return of 0.1%. And then you go from June to November, up a little more than 2/3 of the time with a 3.4% return. This also shows how post-election years have been performing better lately. But then you see this where summer tends to be weakest, but yet we're setting all-time highs with the S&P. And when we go back to 1950, looking at just post-election years for August, the S&P is up 8 out of 18 times, down 10 out of 18 times with a return of a minus 1.2%. Then this I've also been showing on the daily side. This is put out by Carson, showing how there's some weakness that we haven't seen yet, but this is typically what happens when we get deeper into August, September, and then a lot of times we'll bottom out in late September, if not into October. This also shows the lackluster time. We're dealing with the summer months. So, and that you can be real critical of that, but we tend to see a drop off in volume. Now, last week we were above average with volume. This week we spent most days below average with volume, and that's what we see here, both on the NYSE as well as the NASDAQ itself. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.